Thank you everyone for coming today. My name is Abby Ostriker. I'm a first-year assistant professor, so I'm going to be talking about property insurance and climate risk. I'm going to spend the first 2/3-ish just talking about generally what's going on in these markets, and then I'll finish up with a preview of some early stage research that I'll be excited to share with you. Okay, so I want to start by noting that home insurance premiums, which have grown by about 30% over the last 5 years, are expected to grow even more over the next 3 decades due to climate change. So what I'm showing you here is a map of predicted increases in home insurance premiums according to the First Street Foundation due to climate risk. So you can see that there's going to be a lot of growth on the West Coast, kind of the western half of the US. This is an area where wildfire risk is really prevalent. And there's also going to be a lot of growth in the southeast of the US where hurricanes are a big concern. Getting into specific numbers, the First Street Foundation predicts that in Sacramento, for example, home insurance premiums will go up by 137% by 2055. So this is kind of a big deal. Okay, so to me this raises a couple of big questions that kind of interact with each other. So one of them is, how is this climate risk going to be impacting insurance markets more broadly, not just affecting the price, but what's happening kind of in the market? And then circling back, are those insurance markets going to then be impacting that climate risk? So both of these questions are kind of at the heart of my personal research agenda. Okay, so first, taking this first question, what do we think climate risk is doing to the insurance markets? You might expect that as risk goes up, consumers might find insurance to be more valuable. They might actually demand more of it. And so as prices go up, you might think that the demand will increase and quantity will increase as well. But this is actually not what we're seeing in this market. So every month, practically, there's a new headline about wildfire risk or other climate risk increasing, insurers pulling back, home insurance becoming almost impossible to buy in some markets. And so this is maybe in some sense a puzzle. If risk is going up, why aren't people buying more insurance? Okay, so there's a couple of potential answers to this question. One of them is that homeowners might really be underestimating their climate risk. This has been observed more in the academic literature in the flood insurance context, where take-up of flood insurance, which is in many cases voluntary, is super low, even though this flood insurance is pretty highly subsidized. It's also been observed that in the property insurance context, homeowners are choosing coverage limits that are not enough to cover the rebuilding cost when a disaster happens. So it could be the case that as this climate risk is growing, homeowners are underestimating how much that risk is growing, and so their willingness to pay for insurance is not commensurate to the growing costs. It's also the case, though, that even if consumers were correctly perceiving their risk, there's a nuance to the correlation of this risk across consumers that could still be generating too low demand. So the issue is that natural disasters happen to a lot of people all at once. And it is more expensive to pay out when you have to pay out a lot at once. This is different from the typical health insurance or auto insurance context, where you can expect a pretty stable share of your consumers to need payouts every year. But natural disasters are lumpy. And so it could be the case that climate change might be making a certain amount of increase in risk for individual homeowners, but it could be increasing the correlation of risk across space. And so it's more expensive to insure a given individual because their damages are happening at the same time as everybody else. So that could be another reason that we're seeing a willingness to pay from homeowners that's not commensurate with the cost of providing that insurance. I would be remiss if I didn't also mention another feature of these markets, which is that there's a heavy regulatory presence because there's also a lot of antitrust concerns. And so in some states, we might be seeing that regulators have capped insurance premium increases to a certain amount, and insurers might find that it's not profitable to offer insurance in some areas because of that. And so that could be why we're seeing some insurers pulling out of these markets. Okay, so these are a few of what I think are the main reasons that we might be seeing these markets being really disrupted. What can we do to fix it? Okay, how can we regain equilibrium in these markets? So if the problem is that homeowners are misperceiving their risk, we would think a natural solution would be to give them more information, right? And so this is an active area of research on how to best provide that information to homeowners. My read of this literature is that you need to be careful about it. You need to design this information pretty carefully because there's some studies that find that even if you do provide that information, even high-risk homeowners might not increase their demand for insurance. So you have to be careful about this. If the problem is the correlation of risk across your insured pool, an insurer might want to diversify their own set of consumers, right? But that could lead to them dropping people in these high-risk areas. And we would need to bring in other insurers to fully kind of insure these areas. There might not be enough really well-capitalized insurers to fully diversify all of this risk. So that's something to consider. So that leaves us with another option, which is actually reducing the physical risk that these homeowners are facing. So one way that we've been thinking about doing this so far is insurers could provide discounts for individual homeowners to protect their own properties. California has actually started requiring insurers to offer these discounts. It's a bit challenging though, because insurers don't yet know how much they want to offer as a discount. So currently they're offering almost zero. This can also be difficult because once you offer these discounts, then you have to start monitoring for them. It can be very expensive to monitor things like, did you rake out the leaves from underneath your deck? That's just very, very, very hard to do, even though it can be really important for your risk. So companies are going to have to figure this out. And then another question is, to what extent are these problems even slightly self-correcting by the mechanism of higher premiums discouraging development in risky areas? You might think that if home buyers are now kind of a bit more aware of the risk when they're choosing a home, that they might not demand homes so much in areas that are risky and have high premiums. On the other hand, the nature of the information frictions might lead them to buy these houses anyway. So this is the question that I want to address in this research project. So the question is, again, do higher insurance premiums discourage development in risky areas? Now, just comparing high and low premium areas, we might run into the issue that there are other factors associated with premiums that might affect development. So for example, places with less restrictive zoning might have higher risk, and that could discourage development on its own. So what I'm going to do is leverage a feature of California's regulatory environment that says that insurers need to base their statewide increases on their historic losses. And so there was unfortunately a spate of wildfires in California from 2015 to 2018 that generated large losses and triggered big increases in premiums. But insurers who had bigger losses could increase their prices more in principle. And so we can use this variation in insurer mix across zip codes to get variation in the growth in premiums. So this map is showing you the zip codes in the study. The red zip codes are ones in the top quartile of loss ratios from these fires. These are the ones that are going to be my treatment group, and then the pink ones are going to be the control group. They also had losses, they just weren't quite as high. Okay, I got data on the insurance premiums averaged at a zip code level in California across this time period. So that's plotted on the left-hand graph. The treatment group is this solid line, that's the top line, and the control group is the bottom line. And you can see from 2010 to 2015, prices were pretty flat, and then they started going up. And it looks like they started going up a little bit more for this treatment group. How much is kind of hard to eyeball, and so the right-hand side is showing you the difference in difference coefficients on year for the treatment group relative to the baseline of the control group. So this is showing you how different the treatment groups would be relative to their kind of counterfactual path if they had looked like the controls. So we can see that prior to the wildfires, there's no difference, and so that reassures us that the treatment and control groups are quite similar. Afterwards, we see the prices increasing faster, up to about $300 a year more in the treatment groups relative to the control groups by 2021. Okay, so this is telling us that we should be able to use this treatment and control group to look at the effects of these higher premiums, knowing that everything else is kind of similar in these zip codes. So what am I going to look at? I want to look at the development response. I want to look at this in kind of two complementary ways. One of them is going to involve the core logic data set on housing. And I would build a panel of houses, of newly built houses each year to look at, is there more construction in zip codes with higher premiums? I also have a data set from California's mapping and monitoring program that looks at land use changes every 2 years. And this is very granular spatial data that will also allow me to look in a kind of broad sense, is there more kind of public development happening as well? And then if funding and data sources allow, I'm also looking into obtaining data on construction permits to get at whether houses that exist have more investment happening in them as well. Like, are you doing kitchen renovations less? Are you maybe expanding your square footage less if you're in a place with higher insurance premiums? Okay, so zooming out, I think that we probably all have a sense that homeowners insurance is really critical to the functioning of real estate markets, but that climate change is increasing the risk of natural disasters, and that is throwing these insurance markets into disarray for a number of reasons. What I would like to do is to try and kind of unpack those and see whether there's any part of the system that is self-correcting to investigate whether higher prices might mitigate physical risk by reducing development in these risky areas and helping these insurance markets function a little bit better. Okay, that's all I have. Thank you so much.
Hey, Abby, that's really interesting. I worked in risk management for insurance for 4 years. A lot of insurance companies sequester their risk in the California market, the Florida market, and other high-risk markets to isolate the loss for the company. For the markets like, for example, Texas isn't generally sequestered for the rest of the country. Like, how does that, are you going to look at how that affects the rates in Texas that is being kind of spread across the rest of the country versus California or Florida, where those risks are really focused in those particular communities?
That's a great question. So as you flagged, yes, like it varies kind of state to state whether some of these companies are kind of siloed off. I think you're asking a question that's different from this research project, but is very interesting about whether that siloing kind of affects how the companies are maybe setting their prices or writing their contracts. It's a great question. The one thing that I know that has been written about this is some people have found that companies can kind of subsidize across states, that if there are certain regulatory systems that make it hard to update their prices in California, some insurers will instead compensate for losses in California by increasing their prices elsewhere. So that speaks to that a little bit, but I think it's a very interesting question. Yeah, thank you.
Hi, very interesting presentation. Personal anecdote, I've taken my health insurance post-COVID after understanding the risk, right? And it's very different to see that the risk after knowing that there are calamities or climate climate issues and people not really taking home insurance. That's a little, I mean, I predict that whenever there is an when the high risk, people tend to actually, out of panic, purchase or do things. But for me, I see a market opportunity when it comes to purely insurance companies promoting their products at this point in time. Did you see anything from that aspect in terms of just insurance companies leveraging the situation to promote their products?
Insurance companies want to highlight the risk,
Right.
to highlight the value of their
Correct.
products. I am not a marketing professor, so I don't think I can speak to that side of things so much. I think that homeowners insurance specifically, is frequently required by banks. So you have to get a certain minimum level. And then I think homeowners tend to want to get kind of the least costly possible version of that. So what I've seen more is insurers trying to make things appear cheaper. So they might say like, oh, you don't need this high level of coverage. You can get away with this lower level of coverage because that'll make it cheaper. And it's hard to know how much it will cost to rebuild your house. Most of us aren't experts in that. And so that might be an easier way for the insurers to market, but that's maybe not kind of socially beneficial. Yeah, thank you.
Couple more questions?
Not with regard to wildfires, but specifically for flooding. And here in Boston, of course, we see it, that
Yeah.
high tide dump on the Marriott Long Wharf, waters.
Absolutely.
Do self-insurance groups provide any kind of a partial solution to this, where companies who take care of themselves and homeowners, they get together, they get a company to cover their top risk, but they pay based on their risk for the group? Are you familiar with?
I haven't heard very much about these. Yeah. But I would be very curious if you can connect with me to tell me more. Yeah.
Some kind of P&C like workers' comp, they're fairly prevalent.
Yeah, that would be my guess, is it's very niche, especially because of this issue of correlated risk. Like if you're a group in Boston and one group gets, one company gets hit, they probably all have gotten hit. And so you want to really be more diversified.
In wildfire, everything goes.
With flooding also, flooding is also very correlated. Yeah.
We'll go 3 more questions.
Hi, thank you. It was really interesting to see the effect of climate change on insurance price, and you also state about the reverse effect of like insurance adjustment in pricing affecting the climate change. Can you talk more about that? That seems really interesting.
Great. So the point I was making was not quite about climate change, but climate risk. So sorry to go back so far. This is climate risk in the sense of like what development is happening. I think that the channel for insurance prices to affect like emissions and climate change in that sense is much more limited. Yeah, we're just thinking about like the exposure to these different natural disasters. Yeah, thank you.
Thank you for this one. I'm a little bit curious, like, their role reinsurer or reinsurance companies can play in mitigating this kind of problems.
Great. So there's been some papers finding that the increase in premiums is substantially due to increases in the reinsurance prices that reinsurers are charging. And so this is kind of the mechanism through which maybe the expectations of climate risk can get passed on and priced in. But I think reinsurers are not very well equipped to be monitoring the risk like really on the ground of individual properties. That's kind of more the role of these insurers who are enforcing their own contracts. And so I think that the reinsurers can be communicating that overall risk, but reducing the exposure at a micro level is going to be hard for them.
Great. Okay, thank you, Abby. That was
Thank you.
fantastic. So relevant and timely.